Have you ever wondered what truly triggers a stock market crash? It's not just bad news, there are deeper mechanisms at play. To understand this, let's break it down into a few key components. First, think of the stock market as a massive auction house. Every day, buyers and sellers come together, and prices fluctuate based on supply and demand. When people feel optimistic about the economy, they're eager to buy, pushing prices up. But what happens when fear sweeps through the market? Suddenly, everyone wants to sell, and prices plummet. This shift from buying to selling is often the spark that ignites a crash. Now, here's the surprising part. It isn't just emotions driving these changes. Consider the role of leverage. Many investors borrow money to amplify their bets. When stocks start to drop, the lenders demand their money back, forcing investors to sell even more shares to cover their losses. This creates a snowball effect. As more people sell, prices drop further, triggering even more selling. It's like a chain reaction. One small panic can escalate into a full-blown crash. But we can't ignore external factors either. Economic indicators like rising interest rates can signal trouble ahead. When borrowing costs increase, businesses slow down and investor confidence falters. This is another layer of complexity that can lead to a market downturn, often without warning. So a stock market crash usually happens because of a combination of fear, leverage, and external economic factors, creating a perfect storm. Understanding these mechanisms helps demystify why crashes occur and prepares you for the unpredictable nature of the markets. What actually triggers a stock market crash? It often starts with fear. Imagine you're at a concert and suddenly someone yells fire. While there might not be an actual fire, the panic that ensues can turn a crowded venue into chaos. This is similar to how fear spreads among investors. When news about a recession, geopolitical tension, or unexpected economic data surfaces, it sets off alarm bells. Investors sensing trouble on the horizon start to worry. And here's the surprising part. It's not just the bad news that impacts the market, it's how people react to that news. Picture a game of dominoes. One piece tips over, and the rest follow suit. In the stock market, once a few investors begin selling their shares, others take notice. They fear missing out on their chance to get out before prices drop even further. This collective fear can snowball, causing a massive sell-off that drives prices down rapidly. The mechanism behind this panic is rooted in psychology. Many investors behave not just based on facts, but on their emotions. They might think, if everyone else is selling, I should too, leading to a herd mentality. And as more people sell, the stock prices decline, making others even more anxious to sell before losing more value. This psychological trigger can create a feedback loop. Fear leads to selling, which drives prices down, leading to even more fear. So the next time you hear about a market crash, remember that fear and panic can often be the key drivers behind those rapid and dramatic price declines. Understanding this can help you recognize the human element in market dynamics. If you're curious about what happens next in this cycle, stay tuned for the next part of our exploration. Have you ever wondered how borrowing money can actually contribute to a stock market crash? Let's break it down. Many investors use leverage, which is essentially borrowing funds to purchase more stocks than they could afford with just their own capital. This strategy can amplify gains when the market is rising, but it carries a significant risk when prices start to fall. Imagine you own a small bakery. You have $10,000 to buy ingredients and supplies, but you decide to take out an additional $10,000 loan to expand your inventory. Initially, this lets you bake more goods and increase your sales. But then, if a sudden storm hits, like a market downturn, and your sales drop, you still have to pay back that loan, even while your profits plummet. Here's where it gets tricky. In the stock market, when prices begin to fall, those who bought on margin receive a margin call from their broker. This means they must either deposit more cash or sell some of their stocks to cover the borrowed funds. If they can't meet the margin call, they're forced to sell, creating even more selling pressure on the market, which drives prices down further. This is like a domino effect. As one investor sells, others follow suit, fearing they'll be the next to face a margin call. And here's the surprising part. This chain reaction can lead to a much larger market crash than any single investor's actions might indicate. Understanding the role of leverage helps us see how interconnected the market really is, and how quickly fear can spread in a downturn. So, leverage can amplify both gains and losses, playing a crucial role in market drops. It's a reminder of how important it is to understand the mechanics of investing beyond just the stock price. If you want to keep learning about the stock market, stick around for more insights. What if I told you that the stock market often has its own set of early warning signs? Economic indicators serve as crucial signals that can foretell trouble ahead. Think of them as the market's version of a smoke detector, alerting us to potential fires before they fully ignite. Take unemployment rates, for example. A sudden spike in unemployment can be like the canary in the coal mine. When people lose their jobs, they have less money to spend. This results in decreased consumer spending, which is essential for companies' profits. If a company starts to report poor earnings because of lower consumer demand, investors begin to worry, leading to a sell-off. It's like watching a game where the scoreboard is flashing red. You know something's off. But here's where it gets really interesting. These indicators don't just show up out of the blue. They build a narrative over time. When you see a trend of increasing unemployment rates, it's a signal to investors that the economy might be slowing down. And here's the surprising part. Even small fluctuations in these numbers can trigger big reactions. A slight rise in unemployment can cause a flurry of sell orders as investors rush to get out of the market, fearing a larger crash down the road. Then there are other economic reports, like GDP growth and inflation rates. When these numbers start to trend downward, especially if they're below expectations, investors get jittery. The stock market is deeply intertwined with our overall economic health, and when the signals turn negative, it's not uncommon to see panic selling. So remember, economic indicators are like warning signs on the road ahead. They give investors a chance to adjust their strategies before a potential crash, and understanding them can empower you to see the bigger picture. If you want to dive deeper into market dynamics, consider subscribing for more insights. Why does market sentiment matter in the context of stock market crashes? Well, here's the surprising part. Market sentiment can actually create a self-fulfilling prophecy. When enough investors start to believe that a crash is coming, their collective actions can trigger that very event. It's like a crowd at a concert. If one person starts to panic and run, others will follow, amplifying the fear and chaos. Imagine a school of fish. If one fish suddenly darts away because it senses danger, the rest of the school will instinctively follow, even if there's no real threat. This is similar to how investors react in the markets. If news outlets start reporting on a potential downturn, or if a few influential investors express their worries, it can lead to widespread selling. The more people that sell, the more the prices fall, which in turn reinforces the fear that a crash is inevitable. Now let's dive into speculation, which can create bubbles that eventually burst. Speculation occurs when investors buy stocks, not necessarily because they believe in the company's fundamentals, but rather because they think they can sell them to someone else at a higher price later. This can lead to inflated prices that don't reflect actual value. Think of it like a game of musical chairs. Everyone is excited and buying, but when the music stops, someone is left without a chair, or in this case, an asset of value. These bubbles are fueled by optimism that can quickly turn into panic. When the reality sets in that a stock is overvalued, people rush to sell, causing the bubble to burst and leading to a market crash. Understanding this relationship between sentiment, speculation, and actual market behavior is crucial for grasping how crashes can happen, often when we least expect them. What really happens behind the scenes when the stock market crashes? It's a mixture of fear, leverage, economic indicators, and market sentiment, all swirling together like a storm before a downfall. Let's break it down. First, consider fear. When investors start to panic, they rush to sell their stocks to avoid losses. This is often triggered by negative news. Think economic downturns, political instability, or even rumors. As more people sell, prices drop, creating a snowball effect. It's like a group of people at a concert who suddenly hear a fire alarm. One starts to run, and soon everyone is sprinting for the exits. Next is leverage, essentially borrowing money to invest. Many traders use margin accounts, which allow them to buy more stock than they can afford. In a stable market, this can amplify gains, but during a crash it can amplify losses. When stocks plummet, brokers may issue margin calls, forcing traders to sell even more to cover their debts. This can exacerbate the decline, much like a person trying to save themselves from drowning, but inadvertently pulling others down with them. Then we have economic indicators, data points like unemployment rates, consumer spending, or inflation. If these signals turn negative, they can shake investor confidence. For instance, a rising unemployment rate, might lead investors to believe that a recession is imminent, prompting them to sell off stocks preemptively. Finally, market sentiment ties everything together. It's the overall mood of investors. When sentiment is positive, prices can rise on optimism. But when fear takes hold, it can rapidly shift to negative sentiment, triggering that cascade of selling we talked about. So in summary, stock market crashes are driven by a complex interplay of fear, leverage, economic signals, and shifting sentiments. Understanding these mechanisms can help demystify why they happen, making the next downturn a little less daunting. If you found this insightful, consider subscribing for more clarity on market dynamics.